Welcome back to Driva, the climate investment series for everyone interested in climate action. Remember, if you don't catch us live, you can watch each segment on our YouTube channel or right here on Facebook. Climate risk introduces many new parameters for managing portfolios, especially because historical data gives little prediction of things to come. So how do you predict climate risk and how it impacts your portfolio? With us today is Lars Erik Mangset from KLP, who has hands-on experience from the UN Climate Risk Project, and he's here to tell us more about how to evaluate climate risk across asset classes.
Hello, my name is Lars Erik Mangset. I will talk about KLP's approach to climate risk. And in this presentation, I will talk around two key points. Why does KLP address climate risks and how do we do it? So climate risk occur due to the uncertainty from climate-related development and the financial consequences it may have for KLP. If we fail to mitigate emissions to the extent recommended by the scientists, we will be affected by more extreme weather, changing weather patterns, sea level rise, and more. And the exact consequences from this is uncertain, but it will likely entail issues such as asset damage, supply chain disruption, and various forms of social risks. And in the worst scenario, the so-called climate tipping point will be reached, at which point there will be internal dynamics in the climate system itself that will further drive emissions and climate change. But this is, of course, what we want to avoid. And the world community has agreed that we should avoid the most dangerous forms of climate change. But reaching the goals in the Paris agreements require fundamental changes in our economic system. And if this transition to a low or zero emission society happens too fast and too sudden, then the transition in itself poses a financial risk, for instance, in the form of significant devaluation of asset prices. And I think that in facing the concept of climate risk, I think many find it difficult to grasp. You need to look into the very uncertain future. You need to anticipate what events may happen in the future. And it's also difficult to understand how companies and markets will respond and manage the different risks that emerge. And from a very practical point of view, there is a significant lack of available data today to analyze it in a very good way. But despite this, I think it's increasingly difficult to ignore climate risks. And I will point to three drivers for this. The first one is that central banks, financial supervision authorities, and ministries all over the world actually are now pointing to the materiality of climate risk. It's seen as a systemic risk that can pose a threat to the financial stability, and we need more information about where the risk is and how it is managed. We also see more regulation being introduced, and in particularly relating to reporting of climate risks. In France, it is already mandatory to report on climate risks. There has been signals in the UK that it could be mandatory by 2022. And we see that EU directives, both directly and indirectly, is now addressing climate risks. Now, the third driver, which I think is very important for companies, is that we now have a standard view on what climate risk is, and how it should be analyzed and reported. And this was put forward by the Task Force on Climate-Related Financial Disclosures, also called the TCFD, which in 2017 put forward their recommendations. And we see now that more companies are reporting on the basis of the TCFD recommendations, and KLP started doing that already last year in our annual report. So I think our main message is that even though climate risk can be difficult to grasp and make concrete in the same way as we are used to with other risk analysis, we have to address this due to all these various reasons that I mentioned right now. So now I will turn to the second part of my talk and talk a little bit about how KLP are approaching climate risk. Now, I just want to say first that the introduction of TCFD in 2017 really broadened our view of what climate risk is. And I think it's fair to say that the TCFD, they really broaden the scope of risk factors to be addressed in the analysis, but also introducing the concept of a scenario analysis, which means that you need to have a qualified view on how you think the future may unfold. And this increases the complexity of the analysis in itself. I think it's fair to say that there is limited knowledge and data on this topic. And on that recognition, KLP felt that it's really important for us that we build internal knowledge on climate risk. We need to have a common view of what it is, and we need to develop the competencies within the different people in our company that either today or in the future will be working on climate risk management. So in this slide, I've basically tried to summarize a little bit on how we went about doing this. And the main approach that we had was that we felt that we should develop our competencies by actually trying to do a climate risk analysis. So I sort of like learn by doing. This first part of the figure, it shows how we have divided up KLP in different sorts of segments. So KLP is a life insurance company. Our main product is pension, but we also have banking and insurance services. We have a fairly sizable real estate portfolio, and then we have sort of like the other asset management and we also have our own asset management company in KLP. So basically what we did was we divided a working group and 5 different working groups for each of these different 5 areas. For each of the working group, we went through this scope of risks and tried to identify what kind of risk that plays out for the different parts of KLP. So the first one related to physical risks, and the 4 other categories relate to transition risks. So it's policy and legal risk, technology risk, market risk, and reputation risk. And all of these, on the left side here, you see that we have inserted some delta symbols that is to signify that we also view this in a scenario approach. That could be, for instance, including consideration on how the risk may develop in a 3-degree scenario, a 2-degree scenario, or a 1.5-degree scenario. All of the risks were evaluated toward KLP's common risk goals. So it was, of course, important for us that the work that we do on climate risk doesn't become on the side on what we're already doing, but we're trying immediately to incorporate that aspects in our normal risk processes in KLP. And all of them were then finally evaluated towards a problem statement. The problem statement that you see here is related to KLP as a life insurance company, but we also had individual problem statements for the different segments of KLP as you see on the top where we did the analysis. And I think 2 aspects which is important for the problem statements is, of course, that it should be financially related and it should be incorporated to illuminate how risk can impact the goals of the company. We, for most of the part, for all of the areas beside the asset management, we did this in a qualitative way. So we gathered together different experts. We read a lot of secondary literature related to, for instance, future climate policies or future extreme weather predictions. And then we incorporated that together in using our expert judgment to develop different lists of risks and develop scenarios and evaluate consequences. In the asset management, however, and related to our listed equities and bond investments, we did a quantitative analysis, and we did it in collaboration with other investors and also multilateral organizations. And in the next slides, I will give you some examples on the work that we did there. So this slide is a summary of the quantitative analysis that we did for our listed equities and bonds. And I will go through this figure starting from the left side. So first of all, we we need to define what sort of risk factors that we see from the climate risk domain. And considering that this was a quantitative study, we needed to do a lot of simplifications because there are limits to how much we can quantify. So the first risk factor, which is shown here on top, is related to extreme weather events. And we incorporated, I think it was about 8 different weather-related hazards, such as inland flooding or forest fires or extreme winds. We did not include inland flooding or landslides due to data challenges and computational challenges. And these are, of course, important omissions from the model because they are quite correlated for most part to financial impacts. Then we had 2 risk factors on transition risks. One is CO2 pricing, which was obtained from what is called a REMIND model, which is an integrated assessment model from the Potsdam University. And then we included also an upside risk or a opportunity, which was basically the potential that companies in the future could increase their revenues from green technology. And I think a very important innovation, maybe the most important innovation in this model, was that we also sought to map out where the companies are actually located. So we didn't just look at where the companies have their headquarters registered, but also where they have all their other assets all around the world. That was for a minor part based on subscription, a purchase of data. And for the most part, it was based on machine learning and algorithms that searched through, LinkedIn or Google Maps or OpenStreetMaps or Facebook or other places to identify the locations of the companies. And I think that's a really important aspect when it comes to climate risk, because it can be, for many parts, very local. Extreme weather is a local event. There's different national jurisdictions and climate policies, and ideally this should be incorporated in the analysis. So the risk factors gives changes in the expected incomes and cost of the company. So we did an analysis of a 15-year period, and we looked at the free cash flow of the company. Then we inserted the changes in incomes and costs due to the climate risk aspects, and we discounted that to a present day value using the weighted average cost of capital for the specific company, if that was available, if not for the sector. And by applying the Merton model, we then could identify potential mispricing in equity price or bond price if we then took in the, say, the climate risk lens. This was then aggregated from asset level, company level, and then to portfolio levels in order to give KLP a sense of the cumulative impact. So on the next slide, I will show you the results that we did from the first modeling approach that we did using this analysis. So this is basically showing the results for KLP's cumulative equities holdings. The graph can be read like this. The vertical axis is the value at risk in percentage. So 1% up means that the share prices goes up 1% and vice versa. We modeled using 3 different transition scenarios. A 3-degree scenario where we are actually heading based on today's policies and what is being reported into the Paris Agreement. A 2-degree scenario and a 1.5-degree scenario. In addition, we included expected extreme weather, and we applied the tail risk, so the 95th percentile risk. And from the graph, you can see the different risk contributions in green. That is basically the technology upside opportunities. The black is the carbon price exposure, and the 2 ones in blue is the total extreme weather risk. The red dot signals the weighted risk contribution, so we can read it that in the 3-degree scenario we have a 1% mispricing. We have slightly less than 2% mispricing in the 2-degree scenario, and a 3% mispricing in the 1.5 degree scenario, again for a 15 years period. So this was for the period 2018 to 2033. Now, there is, I think we should be very careful in interpreting the actual results from this analysis, but I think what could be some interesting observation is, of course, that the more extreme the transition risk scenario is, the higher is the risk. And we also see from this model that extreme weather is modeled as a less significant risk than the transition risk for the next 15 years, which of course can, for some, make some sense. This is aggregated for KLP, and we did the analysis on the different funds that we invest through. And we also see that, for instance, our globally diversified index fund performs closer to zero. So in the model, the fund achieves or succeeds with risk diversification. We also see that our eco-label fund, which is fossil-free and have some rules when it comes to ESG tilting their investments, we also see that that fund performs positive the more extreme the transition risk scenario is. But as mentioned, we have a very careful interpretation of the outcome of the analysis. But I think the most important part for us was actually to learn a little bit about climate risk assessment and the quantification of that through this exercise. And I just want to point out just one example of, I think, was an important learning effect for us when conducting this analysis on the next slide. So this shows the climate risk contribution distributed on the different sectors. So these are GICS sectors, and this is an example from KLP's Global Index Fund. The vertical axis is the same as the previous one, so this is weighted risk contribution. And what we can see here is that we see that electric utilities and multi-utilities are quite significant drivers of the risk in this model. But from a real-world consideration, we can think about what will happen if a power producer is exposed to a carbon tax. Well, for most part, they will try to pass that cost on to their customer. And this sort of dynamics, how different companies, how different markets, how different value chains react to different risk events, is not part of a quantification and an analysis as we have conducted here. This becomes a very much like a very static analysis where the risk are repeating itself every year for 15 years, and all the actors are basically not responding to it at all. So this is not, of course, very realistic from a real world perspective, and I think these considerations is really important for us to have back in our mind when we are advancing our work on climate risks. So finally, I just wanted to provide some reflections from our side. I think, as I mentioned initially, is that I think for at least for us, and I guess for others as well, is that climate risk assessment, as TCFD is recommending us to do it, is quite a daunting task. It's complex, it's new for many. The way that we think about around risk, I think is probably something that needs to be innovated as well. But I think that there is there are some very easy way of getting started, and our experience is that learning by doing process, where we're identifying risk and learning at the same time, proves quite effective for us. I think in the simplest way where you can start is just having a qualitative workshop, bringing out different experts, sitting together for 1, 2, or 3 hours, and identifying which risk you think is material for your company, how they may play out in different scenarios, and give a traffic light assessment of the consequences of the different risks. A little bit more advanced, the step could perhaps be to utilize already company data. It could be self-reported data, or it could be ESG data, which is procured from third parties. There's always the option of procure a dedicated analysis, and I think that's a very viable option for many, but I think it's also important to be critical when it comes to what the analysis actually gives you in terms of legitimate results. And then, of course, many can develop their own data sets. I think on the figure on the right side, I think that really illustrates the way that we are working on building our internal capabilities. I mean, we are doing this work. Through this work, we are creating a common understanding on climate risk and what it is. We try to have a broad involvement in our company and use that as a way to nurture competence development. And over time, we see that we are developing data and tools and methodologies for risk assessments. But of course, it will take some years for us to being able to develop a risk analysis which carries the same level of precision as perhaps the other risk analysis that we do. But nonetheless, even though that the analysis today is not perfect, we are continuously working on integrating climate risk aspects. We have already, as I mentioned, reported on our work in our annual report. Last year, we started to including climate risk as cases to our reporting to the Financial Supervision Authority. And we are working on finding also other ways of integrating this into our risk management processes, such as the internal audit processes. So if I should provide one key message to others based on the learning that we have done, is basically just get started with the work. Do it within the resources and capabilities that you have available, and then develop it from there. So I think that was everything I had time for. Thank you very much for listening, and thanks again also for inviting KLP to provide this talk.
Thank you so much, Lars Erik, for that recipe for climate risk action. Many of you may still have questions, so just keep them coming. Lars Erik will be with us in the comment section. And don't forget, join us on Thursday at 12:30 when Ellen Quigley, researcher at the Centre for Existential Risk in Cambridge, will share more on active ownership in a climate perspective. See you then, and thanks for watching.